How to get started investing into Bitcoin as a company and navigating tax considerations. In the past few months, we've seen a new narrative emerge, a narrative of institutions and corporations showing increasing interest for Bitcoin and other cryptocurrencies. The recent mega Bitcoin purchases by companies like Square for $50 million, MicroStrategy for $435 million, and Tesla for over $1 billion certainly have made the headlines and have made it even more popular for corporations to invest in. Under the surface, however, this trend started much earlier during the bear market of 2018. Top-tier firms like Andreessen Horowitz doubled down on their crypto bet while half the world had lost its interest in crypto and closed two dedicated crypto funds totaling over $815 million of capital commitments. Equally famous is the story of Paradigm, which convinced top institutional investors like Harvard and Stanford to give them $750 million to invest in a market they were too blue-blooded to touch directly. Paradigm then invested the full amount of its initial capital in Bitcoin and Ethereum in 2018 at burst bubble discount prices, and needless to say, these investments have paid off. Bitcoin and Ethereum's value has more than quadrupled since Paradigm and A16Z investments. MicroStrategy Bitcoin investments is up $100 million since the time of purchase a month ago. And the space has won unlikely new allies, such as JP Morgan, Mastercard, and Visa, all of who are also planning on investing heavily into crypto. Now, why should companies invest in crypto? It's a new asset class, and Bitcoin took time to build a price history and some sense of the cycles it goes through. Today, crypto's value proposition is better understood by most sophisticated investors and seen as a welcome asset to expand and diversify their largely fiat-denominated balance sheets. Moreover, given the negative interest rate environment that we're currently experiencing, holding cash has become expensive for companies. Investing into Bitcoin and other cryptos appears therefore like an increasingly rational choice. Bitcoin is a store of value, aka digital gold. One of the primary functions of money is to be a store of value, a mechanism to transfer purchasing power across time and geography. Gold has been trusted as a store of value for many ages, and the primary reason for gold's status as a store of value is that the supply of gold on Earth is scarce. Confidence in its store of value qualities rests in humanity's understanding of nature, that gold is limited and cannot be cost-effectively synthesized. Well-established fiat currencies like the US dollar or euro can also be thought of as a good store of value. Confidence in fiat currency rests on trust in the government. Example, to wisely manage their monetary policy. There is great efficiency in placing such trust in a single institution, but there is also massive risk. Fiat currency can lose credibility and be devalued through the actions of the government, who in time of crisis may face short-term pressures that outweigh concerns for long-term credibility. Contrasting these two stores of value, we can think of the US dollar as a centralized monetary asset which can be devalued by a single actor, and gold as a decentralized monetary asset which cannot. Now, Bitcoin shares this and many other characteristics like gold. Like gold, Bitcoin has a finite supply. Currently, the supply of Bitcoin is close to 19 million. Over the course of its lifetime, it will asymptomatically approach 21 million. Achieving scarcity in digital form was Bitcoin's great technical breakthrough, building on decades of computer science research. Arguably, Bitcoin is even more scarce than gold, as gold's total Earth supply can only be guessed, not known for certain. New discoveries keep making the news. Moreover, like gold, Bitcoin is hard to mine. In the Bitcoin network, miners have to put computing power to use in order to validate transactions. The process is both hardware and energy intensive. However, unlike gold, Bitcoin is digital, portable, and censorship resistant. The fact that it's digital means that it's cheaper to store and easier to transfer than gold, which is physically very cumbersome. These properties are especially useful in times of capital controls or expropriations where Bitcoin cannot be seized as the currency is transferred over a peer-to-peer network and held in private Bitcoin networks, unattainable by anyone but the owner holding the private keys. And to conclude, Bitcoin bears many similarities with gold, but also possesses a number of qualities that physical gold does not have. Qualities that are increasingly valuable in a digital first and globalized world. And the difference is mainly that Bitcoin is newer and with a smaller market cap with more explosive upside and downside potential. A so-called asymmetric bet. Moving on, how to buy Bitcoin as a company. If you've never bought Bitcoin or other cryptos before, this question might be daunting. Where do you buy Bitcoin and how do you do it and where do you store it? The most common method to buy Bitcoin is to buy it on a crypto exchange. Just like any traditional brokerage account, they let users transfer funds into the account by bank transfer and place orders on their order book. 1. Sign up for a crypto corporate exchange account. The first step that you have to undertake to buy Bitcoin as a company is to sign up for a crypto exchange offering dedicated corporate accounts like Gemini, Kraken, Coinbase, or River. This is important because in many legislations around the world, it is a lot more complicated to let others buy assets under the company's name. Opening a personal account and trading in the name of the company is therefore not a good idea and could significantly complicate your tax declaration and open up new tax problems regarding your crypto assets. Additionally, in most cases, you will enjoy higher funding limits and better customer support than you would with a personal account. 2. Buy Bitcoin. The first step to buy Bitcoin as a company is to actually place the order. First, you need to transfer funds, euro, dollars, pounds, etc., from your corporate bank account to the exchange. Some business bank accounts block transfers to and from crypto exchanges, so you may want to inquire about your bank's stance toward crypto exchanges beforehand. Once the funds have arrived on the exchange, you have to place your order. Generally speaking, there are two types of orders. If you want to simply buy at the current Bitcoin price, you submit a market order, easy. And if you want to buy at a specific price, you submit a limit order. Market orders versus limit orders. When you submit a market order, the exchange looks at the current sell orders on the order book and calculates a price at which your buy order will be automatically filled. As a user, you only have to enter the amount you want to buy and press on the buy button. Pros of this are easy, convenient. The cons, expensive for large amounts. You'll probably see the price rise as your orders get executed. This is due to the fact that once you finish buying from the cheap sellers, you gradually move to the expensive sellers. This means you don't have a fixed price for your purchase. On the other hand, if you manually create a limit order, you are indicating the price at which you are willing to buy. You're creating a new order on the order book, but there's a corresponding sell offer. Your order will also be filled. The pros of this: more control, fixed price, which is good for buying large amounts. Cons: your order might not be filled if market prices move up and your bid is too low. There is also a third option available if you are interested in buying high amounts of Bitcoin, over $100,000 worth, which is to turn to an OTC desk. Imagine an OTC desk is a bit like a concierge or VIP service, allowing you to place a custom order and fixing a price beforehand. In this case, the trade is not settled on the order book, but in private. Most crypto exchanges have an OTC desk in-house, but there are also specialized OTC desks like Genesis, which are only focused on institutional clients and don't serve any consumers. Many institutional buyers like OTC desks, as they prefer to stay private and get their orders filled fast. When you use an OTC desk, you can call or email your contact person and negotiate a fixed price. 3. Keep your Bitcoin safe. Once you acquire some Bitcoin on an exchange, you have two options for storing them. One is third-party custody. Leave them in the custody of the exchange where you bought them. 2. Self-custody. Withdraw them from the exchange and store them in your own Bitcoin wallet. What's the difference between third-party and self-custody, you may ask? One of the breakthroughs of cryptos, such as Bitcoin, is that users can truly self-custody their digital assets. Users hold their Bitcoin in a Bitcoin wallet, which manages the user's private key and is responsible for signing transactions. Before adding a new transaction to the blockchain, Bitcoin miners check that the transaction is signed by the valid private key belonging to the bitcoins in the transaction. This is why Bitcoin is more like cash and less like a digital dollar in a bank account, which is just an IOU, a claim to receive a real dollar from the bank when requested. With Bitcoin, there's no middleman between users and their assets. However, the freedom that Bitcoin brings also bears some responsibility. When your private key is lost, no one can recover the funds for you simply because there's no third party storing a backup for you. While the funds are still on the blockchain, the ability to move and control them is lost the minute the private key vanishes. Especially in the early days of Bitcoin, people lost significant amounts of money this way. If you opt for self-custody, the best option to keep your company's Bitcoin secure is to get a Bitcoin hardware wallet. A hardware wallet is a little device that keeps your private keys offline and thus removes most attack vectors for hackers. Whenever you want to send Bitcoin, you connect your hardware wallet to an app on your computer and use the hardware wallet to sign transactions in combination with the hardware wallet app. For those who don't want this responsibility, there's also the option to leave the Bitcoins in the custody of the exchange you bought them. Top-tier exchanges have invested millions in the security of their storage systems as it's the core piece of their infrastructure. In addition, many of the top-tier crypto exchanges have insurance policies in case they get hacked. However, before you decide to go down this route, analyze the security page of the crypto exchange you are considering to get a better picture of their security measures. There have been numerous events where low security offshore crypto exchanges get hacked, and don't compromise on your safety and find a crypto exchange with a clean track record. Moving on, what are the tax implications of holding Bitcoin as a company? As cryptos become widely accepted store of value, taxing authorities around the world have responded with varying taxation requirements. Every country has their own specific tax code, which will apply to companies domiciled under their jurisdiction. Although there is still massive gray area in crypto tax regulations, it's becoming increasingly more important for companies to understand the taxation rules and regulations that apply to crypto transactions in their jurisdiction. For illustration purposes, I've provided a comparison of relevant tax guidance in the US, Germany, and the UK. US. American corporations looking to invest in Bitcoin must first consider the tax implications. Simply purchasing Bitcoin for a US dollar or another fiat currency does not represent a taxable event. There are other financial reporting considerations that must be taken into account when a corporation holds Bitcoin for investment purposes. A taxable event occurs when Bitcoin is sold for a US dollar or another fiat currency. The IRS has issued current tax guidance and Notice 21421 as a guidance for individuals and businesses on the tax treatment of crypto transactions. The guidance treats crypto as property and therefore the applicable tax principles that apply to property or barter transactions apply to transactions of crypto. There are also state-specific rules around crypto transactions, so be sure to consult with a local tax professional. Tax liability. The amount of tax liability on Bitcoin transactions is dependent on the amount of gain or loss recognized. A capital gain occurs when you sell Bitcoin for more than you paid to acquire it. Capital gain equals sell price minus the cost basis. The cost basis is the amount you spend in US dollars plus any fees, commissions, and other acquisition costs to acquire Bitcoin. If the cost basis exceeds the selling price, a loss is recognized. Corporations can offset gains with losses for tax purposes. Corporate net capital gains are added to the corporation's ordinary income and taxed at ordinary rates. If the total capital losses exceed the total capital gains, those losses cannot be deducted in the current year. The excess losses are carried back up to 3 years and then forward for a period of 5 years to only offset capital gains. Tax reporting. Sales of crypto should be reported on your tax return using Schedule D in Form 8949. And you'll show your capital gain or loss calculations right on the form per instructions. In Germany, for a German corporation who is for a German company who is considering to have crypto as an investment, there are some tax implications they should know about. The difference between private and business assets are very big. All the things you might have heard, like tax-free after 1 year, do not apply for business assets. For taxable events, Germany does not have the concept of a taxable event for business assets. A German business needs to do their accounting with these assets. For cryptos to be included in a balance sheet, they must represent an asset due to the principle of completeness from 246 para 1 sentence 1 HGB. The German commercial law leaves open which characteristics a right or property must exhibit in order to be able to be classified as an asset. In the meantime, however, it has been widely recognized that the essential characteristic for classification is the criterion of individual salability, under which section in the balance sheet an item is listed is important for the evaluation of an asset. Only the item other assets remains as a disclosure option in the current assets due to the lack of currency and securities properties in accordance with paragraph 2 of the German Security Trading Act. WPHG. Such a disclosure is obvious because gold and silver coins for which a cash characteristic is also denied also has to be disclosed here. Tax liability. The tax liability depends on the value of the assets. The tax liability depends on the value the assets have in the balance sheet. All cryptos are generally accounted for according to the strict lowest value principle. Of three possible values, the acquisition or production cost, the stock exchange or market price, and the value to be attributed on the balance sheet date. The lowest value is always to be applied to current assets. Valuation according to the lower of cost or market principle means that unlike unrealized gains, unrealized losses are reported also. Tax reporting. The cryptocurrencies have to be reported as part of the balance sheet. As always, all transactions have to be documented and kept ready for potential requests to the tax office. In the UK, cryptocurrency industry and the underlying tech and the use of crypto is growing at a very rapid pace. Therefore, the accounting and tax treatment also has had to develop to ensure appropriate compliance and reporting. On the 1st of November 2019, HMRC published guidelines related to businesses undertaking crypto transactions. Taxable events. A UK company pays corporate taxes on profits it makes from 1. Doing business, trading profit, 2. Investment income and gains, loan relationship, and 3. Chargeable gain on disposal of assets, tangible and intangible. If the company held crypto as part of the existing trade, then the profit will be included in the trading profit. Crypto is not considered a currency in the UK. In addition, there's typically no counterparty to the crypto transactions. Therefore, the investment in crypto does not fall within the loan relationship rules. A company has a loan relationship if it has a money debt that has arisen from transaction for the lending or borrowing of money. Crypto is considered as an intangible asset, therefore considered a chargeable asset for tax purposes in UK as it meets the following 2 criteria. 1, it is something which is capable of being owned, and 2, its value is capable of being realized. What this means is that the company held crypto is not part of trade, but as an investment, then the disposal of the crypto will give rise to a chargeable gain/loss. Tax liability. If the company makes a chargeable gain from crypto disposal, it does not pay capital gain taxes. Instead, the company pays corporate taxes, 19%, based on the tax rate for the 2019 to 2020 year. A disposal is a broad concept. It includes 1. Disposal of crypto for money, 2. Exchanging crypto with another crypto token, 3. Using crypto to pay for goods or services, and 4. Gift and donation of crypto to another person or charity. Tax reporting. The calculation of a company's taxable profits must be undertaken in the company's functional currency, i.e. generally pound sterling for UK-based companies, and the conversion basis should be appropriate and consistent. Companies are subject to corporate taxes on their profits and gains. Therefore, the gain or profit from crypto activities should be reflected in the financial statements of the business. Financial reporting and corporate tax reporting will follow the company's reporting timeline based on the financial period of the company. Some tools to help with your company's crypto tax declaration. There is an increasing amount of companies or services that help you with the taxation of crypto. Generally speaking, there are 2 types of services: tax calculators and crypto accounting tools. Tax calculator or portfolio management tools let you connect with your company's Bitcoin wallet addresses and crypto exchange accounts to track the performance of your crypto assets in one place. You can then use your crypto trading history to automatically populate your country's tax forms required to report capital gains. The completed tax form can be included with your tax return or easily imported into your generalized tax software solution. Most of these tools also calculate unrealized gains and losses, which assist with tax loss harvesting strategies. The act of strategically selling off assets at a loss to reduce your taxable gains. Accounting tools like SoftLedger or Crypto, on the other hand, are bookkeeping platforms which convert crypto transactions into usable data for accounting and finance. Crypto connects your crypto exchange accounts to your company's general ledger software and automatically tracks and labels every crypto purchase or payment in crypto. You can upload a chart of accounts and assign transactions to individual accounts. Once the transactions are classified, the platform generates standard files that most common general ledger tools will be able to import. SoftLedger is a full general ledger platform that was built specifically for crypto transactions. After connecting your crypto wallets and exchange accounts, the platform provides realized and unrealized gain and loss reporting with cost basis track. In conclusion, all in all, the infrastructure around the buying, storing, and accounting of crypto assets has matured a lot in the past few years. Companies like MicroStrategy, Square, and numerous funds have shown that investing into Bitcoin is worthwhile and doable from an execution standpoint. We expect more and more companies to be interested in the logistics of buying Bitcoin and other crypto assets, and hopefully this provides you some guidance.